What's up, everybody? My name is Zach Pasquarello, and in this video, I'm going to talk about accounting fundamentals for bookkeepers. And also, if you are a business owner, I think this video is going to help you understand accounting in general and how it impacts your business. So if you are an aspiring bookkeeping business owner, this video is great for you. If you're a business owner, this video is great for you. I have been a bookkeeper for the past 3 years, and I make these videos every single day to teach you bookkeeping fundamentals and how to start and grow a bookkeeping business. If you want to schedule a consultation with me, there's a link in the description below. You can use that link, schedule a meeting with me anytime. I would love to work with you, talk about trucking, bookkeeping, your business in general. And then also, if you want to see more videos like this, subscribe to my channel, like this video, and follow along because I post videos every single day. Like I said, this video is going to be all about accounting fundamentals, and I want to focus specifically on the balance sheet. So the balance sheet is a financial statement. It's a snapshot in real time of your business, and it shows your assets, your liabilities, and equity. So I'm going to take a deep dive into the balance sheet, and I'm going to teach you all about assets, liabilities, and equity. So the first thing you need to know is that assets equal liabilities plus equity. And don't worry, I'm going to explain everything in a couple minutes. Okay, like I said, assets equal liabilities plus equity. Now I'm going to explain each of these three categories, and I'm going to give you some examples. We'll start with assets. So we have things like cash or your checking account. And then we also have things like accounts receivable, and don't worry, I'm going to explain accounts receivable in a second. And then finally, we have vehicles and building. So for assets, we have checking accounts, cash, or accounts receivable. So if somebody owes you money, and then finally vehicles, buildings, machines, equipment, any sort of tangible property like that. There are a lot more types of assets, but these three things are the most common assets that I see as a bookkeeper and also as a business. Now, liabilities, we have credit cards. Credit cards are the most common liability, but also kind of like, I feel like people don't really think of credit cards as being a liability. But what happens, you go to the store and you swipe your credit card and you have an expense, but you haven't actually spent any money. So you actually owe your credit card bill at the end of the month. So liabilities are all just loans or money that you owe to somebody else in the future. So assets are like money that you have, or like assets, like tangible things like vehicles and buildings. Liabilities are loans or things that you owe. So along with credit cards, we also have accounts payable. Accounts payable are kind of the opposite of accounts receivable. So if your utility company sends you a bill that you owe next month, that would be an accounts payable. That would be a bill that you owe in the future. And then finally, we just have your loans, your traditional loans. So a mortgage on a house or a car loan for a vehicle. Okay, finally, we have equity. Now there's three different types of equity, and this is just an overview. This is just an introduction to the fundamentals of accounting. So it's a lot more complicated than this, but here is a good overview. So along with equity, we have three things: owner's pay, and then the opposite of owner's pay, we have owner's investment. So if you are a business owner and you just get started and you take $5,000 from your personal checking account and put it into your business, that would go into your checking account and also go into owner's investment. So you're taking $5,000 personal, putting it into your business, that's owner's investment. And then if you're a business owner, every single month, maybe you pay yourself a couple $1,000s, that would be considered owner's pay. So you're taking money out of your checking account and you're paying yourself. And then the final category for equity is net income. And I don't have enough room on the whiteboard, but net income also goes under equity. And net income is simply your revenue minus your expense. Okay, I'm gonna keep this on the board, and now I'm going to give you some examples of how these different accounts interact with each other. Because like I said, assets equals liabilities plus equity. So what does that mean? I'm gonna give you a couple examples, that way you can kind of conceptualize what this looks like. So I already gave the example, owner's investment and checking account. So we're increasing owner's investment by $5,000. We're increasing the checking account by $5,000. So as soon as we start the business, if we look at our balance sheet, all of a sudden we've got $5,000 in the assets and $5,000 in the equity. So Assets equals liabilities plus equity. 5,000 equals 5,000. Very simple example, but we're just getting started. Okay, so like I said, net income is a part of equity. So here's an example. Let's say you provide services for a particular customer or a client, and you send them an invoice. So now you send them a $1,000 invoice. So your accounts receivable goes up by $1,000, and then your net income or your equity also goes up by $1,000. So we still have assets increasing by 1,000, equity increasing by 1,000, assets still equal liabilities plus equity. So all of these examples fall under this idea of double entry accounting. And without getting too in depth with debits and credits, I'm not going to talk about that in this video, but every transaction has two sides in accounting. So there's always got to be a debit, there's always got to be a credit. So in this example, we're debiting the assets and we're crediting the equity, but don't get too caught up on debits and credits. If you are a business owner, definitely don't worry about debits and credits. If you're a bookkeeper starting a bookkeeping business, you need to learn about debits and credits. Okay, so another example, let's say you just bought a truck or a piece of equipment for your business. So you just acquired a $50,000 truck. So your vehicles, the amount of vehicles that your business owns is going up by $50,000. And you also took out a loan to buy that truck. So your loans are increasing by $50,000 and your vehicles are increasing by $50,000. So like every other example, assets goes up, loans go up by the same amount, so assets still equal liabilities plus equity. Another good example, let's say you're using your credit card and you go to Walmart to buy some job supplies. So your credit card, if you look at your credit card statement for that month, let's say you spent $100. So you're going to have a $100 credit card bill. Just to keep it simple, that's the only transaction. So your credit card, the amount that you owe on your credit card is going up by $100. And then your equity, your expenses are going to be negative $100 because you're spending $100 on your business. So that's a business expense. So your net income will decrease by 100. Your credit card bill will increase by 100. And that makes sense because assets equal liabilities plus equity. So we're not affecting the assets up top here whenever we use our credit card to buy something. So we're plus 100, minus 100. Net effect on the equation is 0. Same concept with accounts payable. So if your electric utility company sends you a bill for $200 for this month's electricity bill, and you owe that next month, accounts payable will increase by $200 and your net income will decrease by $200 because of the expenses. So liabilities plus equity is a 0 sum because 200 minus 200 is 0. So it has no effect on the overall equation, which is good because it's not affecting assets. So assets equals liabilities plus equity. It's 0 and 0. Okay, last example, and I touched on this earlier in the beginning, but owner's pay. So let's say, for example, you pay yourself $1,000. So you're going to decrease your checking account by $1,000, and then owner's pay is going to be negative $1,000. So we have negative 1,000, negative 1,000, assets equal liabilities plus equity. Okay, so that was the balance sheet. Now I'm going to talk briefly about the income statement. Now, I don't know why, but in all of my accounting classes I've ever taken, we've always called it the income statement, but every business owner I've ever talked to, every time I use QuickBooks, this is always referred to as profit and loss. So if you're an accounting student, you're going to say income statement for whatever reason. If you are everybody else in the real world, you're going to call it a P&L, profit and loss statement. So this is so simple. So there's two main financial statements that you need to focus on. The balance sheet, we just talked about, assets equals liabilities plus equity. And then the P&L. This is what I send my clients on a monthly basis. And if you are a business owner, you should be checking your P&L at least once a month. So all we have, it's so super simple. Revenue minus expenses equals your net income. That's all there is to it. Revenue minus expenses equals net income. And that is your profit and loss statement. Your net income at the end of the year is what you'll be paying taxes on. That's why this is the most common and the most popular financial statement for business owners. Okay, so if you're a business owner, maybe worry about this, probably not. You can probably stop watching right now. If you are a bookkeeper, pay attention to this. I'm going to talk about a couple ways to enter in transactions related to revenue and expenses, specifically in the QuickBooks software. So For revenue, we have two options. You can either do an invoice or a sales receipt. So you create an invoice if someone's going to pay you in the future. You create a sales receipt if somebody has already paid you. I can't make it any more simple than that, but you would not believe how many people mess this up or just unnecessarily create invoices. Like if you provide services today and somebody pays you $100, there's no point in creating an invoice. You can just create a sales receipt because an invoice creates an accounts receivable. So an invoice creates an accounts receivable and it increases your income. A sales receipt, you just deposit the money directly into your checking account. With a sales receipt, we're not involving the accounts receivable. And if you don't have to involve accounts receivable in your bookkeeping process, I recommend that you don't do it unnecessarily because it just makes everything more complicated. So if people owe you money and if you want to use your bookkeeping software to track your accounts receivable, you're going to need to create an invoice. If you don't want to do that, then all you need to do is create a sales receipt whenever somebody pays you. Same concept with expenses. With expenses, we have bills and expenses. And I'm using these words specifically because these are the exact words that are used in the QuickBooks software. So you can create a bill for an expense that you owe in the future, which is accounts payable. So like I talked about with the balance sheet, if your electricity company sends you a bill, you would record that in QuickBooks if you owe that in the future. So that would be an accounts payable. But the same concept with the invoices, if you're paying all of these things in real time, if you don't need to use your bookkeeping software to track your accounts payable, I strongly recommend don't make your bookkeeping unnecessarily complicated. There's no point in tracking bills if you don't need to. Going to Walmart and spending $100, that would be an expense. If you're paying the landscaping person to mow the grass at your home office and you just give them a $100 check, that would be an expense. There's no need to track bills unnecessarily. So try to keep revenue and expenses simple. Don't overcomplicate things unless your client, the business owner, really wants you to track AR and AP in your QuickBooks. But if not, you can keep it simple, just sales receipt and expenses for revenue and expenses.